Here's the truth. Reverse mortgages can grow your net worth and increase your cash flow. If you follow the rules, I'll teach you today. I'm Ian Murdoch. For the last 19 years, I've specialized in reverse mortgages as a licensed mortgage broker, helping seniors like my parents access over $10 million in home equity with zero foreclosures. In this video, I'll walk you through the calculations to determine how much equity you can expect to access from a reverse mortgage, using a spreadsheet I use with clients. No upsells, just proven strategies. By the end, you'll know how much of your home equity you may qualify to access using a reverse mortgage, including important details that most people miss, when it makes sense to do a reverse mortgage and when it doesn't, what happens later for you, your home, and your heirs, and how to select a reliable mortgage broker and avoid predatory ones. We're going to do a live demo together using the reverse mortgage calculator that you can download using the link below. In that demo, I'll show you how to calculate your potential funds from a reverse mortgage and how to avoid costly mistakes. I'll also explain the factors to evaluate in determining if a reverse mortgage makes sense for your situation. If you stay with me until the end, I'll share an advanced strategy for using reverse mortgages in your retirement planning that can protect your investments from market downturns. Before we figure out how much money you can access and whether a reverse mortgage is right for you, we first need to understand some mortgage basics. I see a lot of people who get their facts wrong about reverse mortgages, and most of the time, it's because they don't understand the fundamental concepts. I'm going to assume that if you're watching this video, you're already familiar with the basic elements of a mortgage and how it functions. We're going to examine the differences between a traditional or forward mortgage and a reverse mortgage. We'll also look at the concept of home equity, the difference between the value of your home and what is owed on your mortgage. So now let's review the difference between a traditional and a reverse mortgage. On the whiteboard, I've listed the elements of a traditional mortgage. This should look very familiar to most of you. You have a home value of $500,000, a mortgage balance of $400,000, and that results in equity of $100,000. So this is the very typical scenario in which you put 20% down and you get a $400,000 mortgage. The payment then breaks down into these four common elements: principal, interest, taxes, and insurance. So you have a small amount of principal going toward the balance every month, which is typical at the beginning of a mortgage, a large amount of interest, and then taxes and insurance. And that leads to a total payment of $3,128.27. So let's look at what changes when we turn this into a reverse mortgage. The home value is going to remain the same, but the mortgage balance is going to be reduced. This is because the availability of a reverse mortgage is somewhat less than that for a traditional mortgage. You're only able to get around $200,000 for this example that I'm showing you, and that results in a greater amount of equity at the end. So the equity that is unavailable in the reverse mortgage is $300,000, but the equity that is available is the $200,000. This also will result in the reduction or elimination of any principal payment, and any interest payment is simply going to be added to the reverse mortgage balance. And that's what makes the reverse mortgage balance grow over time as opposed to decrease over time as a traditional mortgage does. But you will still have the $500 for property taxes and the $100 for homeowners insurance remaining as a payment of sorts. Not a payment that you make to the mortgage company, but payments that you make for housing expenses. This is a basic outline of what the differences are between the two. Now, in the next slide, I'm going to show you some representations visually of how the two mortgages differ. We have a traditional on top and a reverse below, with this axis being money and this axis being time. And so if we look at the traditional balance, Notice that the equity starts out quite small at the beginning because the loan balance is relatively high at that $400,000 level, whereas the balance on the reverse mortgage is relatively low at that $200,000 level, and the equity portion is quite high. So over time, the loan balance on traditional mortgage stays the same relatively for a while and then immediately quickly goes down at the end. And that creates more and more equity as time goes on. In the case of the reverse mortgage, the home value increases at the same rate, but in this case, the loan balance also increases because the interest payments are being added to that loan balance. So we see that loan balance rise and rise, and the equity slightly decrease over time until the end of one's life. Let's say one is 100 years old at this point. It's very likely that one could still have some equity available at that time, but what someone has benefited from with taking a reverse mortgage is the ability to live in this home all of that time without ever having to make a mortgage payment. Now, in preparation for the calculator demo, let's look at the main eligibility requirements for a reverse mortgage. 1. Are you or your spouse over the age of 62? 2. Is the home your primary residence? 3. How much equity do you have? Ideally, more than 50%, unless you have the ability to bring funds to the table. 4. Do you pass the financial assessment? You need sufficient income for home-related costs, property taxes, insurance, HOA dues, and maintenance, as well as basic living expenses and consumer debt payments. Your credit score is considered, but primarily for the purpose of evaluating your payment history. 5. Are you mentally competent or have you set up a power of attorney? And 6. Have you attended reverse mortgage counseling? This is something you do after meeting with a broker like me. If you answered yes to the first 5 questions, you're a likely candidate for a reverse mortgage. Now that you know the eligibility requirements, let's move on to what you're really here for. How much money can you actually access with a reverse mortgage? To figure that out, we'll use this interactive mortgage calculator I've built just for you. This tool will show you exactly how much equity you can unlock based on your age, home, value, and interest rate, and remaining mortgage balance. It's the same calculator I've used with dozens of clients since 2006, and it's yours to download for free. Just pause this video, go to the link below, and fill out your information. Then download the spreadsheet, open it up, and rejoin me here as we go through the live demo together. All right, now that you've downloaded the calculator, please open it up and follow along with me as we go through some of the inputs on the calculator itself. Top left, you'll see that you can book a consultation with me. And in this main box here, these first 4 boxes are going to be the primary inputs that give us the results for the calculator. So the first input is going to be your age. So put in your age here, or the age of the younger of the two of you if you're a couple. We're going to use 75 here. We're going to use a $500,000 home value. We're going to use a mortgage balance of 0 to begin with, and square footage of 2,500 square feet. Next, we're going to go down to the loan information. The HECM loan is the one we're going to deal with here. HECM stands for Home Equity Conversion Mortgage. We're not going to deal with proprietary or jumbo mortgages, which are for larger home values. The vast majority of mortgages that are done are HECMs, FHA HECMs. Then we're going to deal with a term payment type, not a 10-year payment type, which is another type available, which is more similar to an annuity payment over your lifetime. And we're going to assume that you're using the proceeds for living expenses. Now, interest rate. Interest rates on reverse mortgages are going to be adjustable rates, not fixed rates, for the most part, because that gives you access to a line of credit. So when we look at the interest rates available, we're going to go to this website, this NASDAQ website that talks about the 10-year CMT, Constant Maturity Treasury Index. And we see that here on April 9th of 2025, that sits at 4.34%. So we're going to take that number, put it in here, and then The next part of the interest rate is calculated on a margin basis that's added to that index, and that ranges between 1.5 and 3%. We're going to use the middle number of 2.25. And then we've got a mortgage insurance premium. That's your monthly ongoing portion of mortgage insurance, 0.5%. All those total up to be 7.09%. Bring that number back here and continue on down. We've got closing costs. You're going to have three different categories of closing costs. The upfront mortgage insurance premium is FHA's mortgage insurance that allows them to offer this program and provides you certain protections as well. That's going to be 2% of the appraised value of your home. So in this case, we have a $10,000 figure for 2% of $500,000. You'll see an origination fee that maxes out at $6,000, but could be as low as zero, depending on how you select your interest rate. And then third-party fees are going to be ballparked around $2,000 to $4,000. So we're going to list $3,000 for those fixed closing costs. And those are going to be things like your appraisal, your title work, and recording fees. So the total of those is $19,000. That's roughly just under 4% of your home value, which is typical for reverse mortgages. They tend to be between 3 and 4% of your home's value. With a traditional mortgage, that ends up being 2 to 3%. So reverse mortgage closing costs are a little bit higher, but that's primarily because of the mortgage insurance. Then we'll look at annual costs. These are costs that you'll pay with or without a mortgage. You've got taxes, which we're ballparking at $6,000, home insurance, ballparking that at $1,200, and we're going to say that you don't have any HOA fees and that you have maintenance costs of $4,200. Why $4,200? Well, FHA charges or assumes a 14 cents per square foot number in determining how much you'll need to spend each month to maintain your home. So we use their number multiplied by 12. So that gives us a total annual costs of $11,400, just under $1,000 a month. I encourage my clients to set that money aside in a savings account so that that money is available to them when they need to pay taxes, insurance, and other things. So that's a good way of doing things when you have a reverse mortgage, because you no longer have an escrow account in which those fees are being set aside for you. Now, moving on to the right side of the calculator, you'll see that the first item here is blank. We're going to be filling that in. That's the principal limit factor. This is the way that FHA calculates how much of your home's value you're able to access in the reverse mortgage. So let's go over to the PLF table. And remember that our interest rate is 7.09%. So we're going to round down for simplicity's sake because this 0.4% gives us a nice round number to use. So we're going to say that you're 75 years old using a 7% interest rate and you have a PLF of 0.4. Bring that 0.4 back here. And by the way, that interest rate, that PLF table gives you interest rates from 3 to 18% and ages from 18 to 99. And that's just varies depending on your age. I mean, if you're an especially young member of a couple, then you can look that PLF number up here as well. And you'll notice that the older you are, the more money you're able to access in a reverse. The younger you are, the less money you're able to access. And that has to do with your life expectancy. Underneath the principal limit factor, we have the principal limit now of $200,000, which is 40%. 0.4 is 40%. 40% of the $500,000 value. Then we've got the closing costs of $19,000, which are subtracted from that number to give us net proceeds of $181,000. The max line of credit available during the first year is going to be 60% of the principal limit, or up to a maximum of 60% of the principal limit minus your closing costs. So that gives us this number of $101,000. Then the remaining 40% is available after the first year, that $80,000. You'll notice here that your home equity remains at $300,000. You still have equity in your home. if you were to sell your home, that equity is yours. The bottom two yellow boxes are going to show you two different ways that you could utilize your home equity. The first is to use it as a line of credit. Right now, there would be 101 available, a year from now, 181, and 5 through 30 years, progressively more money available to a stunning $1.4 million in 30 years. Then, if you look at this monthly term payment box, you'll see that this illustrates ways that you could take money out each month if you wanted to amortize that over various periods of time. So if you take it over 5 years, you get the largest amount because it's going to be gone at the end of those 5 years. And it's important to recognize that as you're doing your financial planning, knowing that that money is only going to last for 5 years is very important. And you can choose a longer time if that is more in keeping with your financial planning. So those are two different ways that you can use the proceeds of a reverse mortgage if you have a zero mortgage balance. Now let's look at what happens if you have a $100,000 mortgage balance. How does that change things? Well, over here on the right-hand side, we continue to see that the principal limit is $200,000, but that the payoff of the original mortgage and closing costs has jumped from $19,000 to $119,000, meaning that only $81,000 of proceeds are available. Max line of credit the first year, FHA wants to give you at least 10%, so they give you 10% of that principal limit, but that means that the other $61,000 is not available until the end of year one. So right now in the line of credit, you have 20, year one, 81,000 total, and progressively more money is available to you as you approach 30 years. And it's still quite impressive that you have $632,000 available from that small seed of 81,000, given that 30-year time frame and compounding interest. The next box shows you that your monthly payment could be of some amount in this case, a lower amount because you have a mortgage balance to pay off, but still something that gets reduced over time as you try to progressively have it last for longer and longer periods of time. So let's look at the final scenario in which your mortgage balance is, say, greater than average at 50% of your home's value. Let's say you have a $250,000 mortgage balance. So that's going to change our numbers on the right side dramatically, in that you'll have a payoff of $250 plus your closing costs, so $269,000. But with your principal limit remaining at $200,000, that means that you would have to bring $69,000 to the table to close the reverse mortgage. And even once you do that, you still have that $300,000 of equity that sits in your home. So for some of you, that might be possible to take that $69,000 from some of your other assets to use to obtain the reverse mortgage. And you might reason that that makes sense to do because the benefit you receive is the elimination of that mortgage payment. For others of you, it may not be possible to bring that $69,000 to the table, and therefore you may decide not to do a reverse mortgage. So that brings to a close our calculator demo. If you're in the Western states or Texas or Florida, you can book a consultation with me using this link in the top left corner. Now that we've done the calculation of your reverse mortgage, here are a few key things you need to know before you contact a mortgage broker to get one. In the next part of the video, I'll show you who should consider getting a reverse mortgage, who should think twice about getting a reverse mortgage, what happens if you run out of money, what happens to your home and your heirs after you pass, how to avoid falling prey to unscrupulous lenders, and at the end, I'll share with you an advanced strategy for using reverse mortgages in your retirement investment portfolio. First, I want to acknowledge that reverse mortgages face some stigma in our societal discourse. This largely stems from misunderstandings of how the program works. In fact, back in 2006, I was also skeptical of them. I thought they were a last resort strategy, and I thought they left too many ways for people to misbehave. The same concern is often reflected in the media by figures like Dave Ramsey, who take a paternalistic attitude, presuming that seniors lack the ability to understand how this tool works. This is one of the things that makes me so passionate about education. I believe seniors can figure this out and use it to their advantage. The truth is, if you're the kind of person who's financially savvy enough to have purchased a home during your working years, chances are you have the discipline and critical thinking skills necessary to comprehend a reverse mortgage and decide whether it's right for you. So, who should consider a reverse mortgage? Ideal candidate profiles are at least one member of the couple would be 62 or older, that you have greater than 50% equity in your home, and that you're still making a mortgage payment. Now, here are some scenarios where the reverse mortgage enhances financial outcomes. It allows increased cash flow, either by removing a mortgage payment or giving you access to funds. That cash flow is tax-free, which helps with tax planning. The lack of a mortgage payment can allow for earlier retirement. You can use your equity to improve your standard of living. It may enable you to delay Social Security until age 70. It can allow you to live your best life now and have experiences while you're physically able. You can give inheritances early for your child to go purchase a home or for your grandchild to attend college. It allows for charitable giving while you're alive to see the results of your generosity. It can pay for in-home care so that you can remain in your home longer. And it's the only means of accessing your home equity in retirement without taking on a mortgage payment. Next, let's talk about some special situations. If you have no heirs, a reverse mortgage makes even more sense. If there's a significant age difference between spouses, rest assured that the younger spouse will be able to remain in the home until the end of their life. You can make payments to your reverse mortgage if you're concerned about a growing mortgage balance. I like to say that a reverse mortgage has optional payments. It's also possible to purchase a home using a reverse mortgage. I'll be covering that topic in a future video. It's also important to consider integrating the reverse mortgage with your retirement planning. You should talk to your financial advisor about it, or if you are a financial advisor, talk to your client about it. Who should think twice about getting a reverse mortgage? Well, if you don't understand what you're getting with a reverse mortgage, that's a warning sign. It's important to talk with a professional who can help you assess how this tool would work for your particular situation. If you're planning to move or sell in the next 3 to 4 years, you might not be a good candidate because of the time it would take to recoup some of the closing costs, especially the upfront mortgage insurance premium. As we covered in the calculator demo, you may lack enough equity to do a home equity conversion mortgage without bringing money to the table. In this case, you have 3 options. Use other assets to pay to obtain a HECM, sell your home and use the equity to purchase a less expensive home with a HECM, or 3, continue paying on your mortgage until home values increase, interest rates decrease, or your mortgage balance decreases more significantly. What happens if you run out of money? It's important to understand that the equity you can access with a reverse mortgage is an asset you've built up, like your 401k or investment account. Let's say you've fully utilized all the funds within your line of credit. While it's possible you could consider a refinance of your reverse mortgage to see if more equity is available due to increasing home values or falling interest rates, it may be that a refinance won't make sense, meaning that no further funds are available. This is why I encourage my clients to use their home equity wisely during their retirement in coordination with their other assets. Your equity is a finite resource and should be seen as such. Now, what happens later? If you decide to sell your home, you take your equity with you. This is the equity that remains after paying off the existing mortgage balance. If you can't afford annual costs any longer, such as your taxes and insurance and HOA dues, you may have to sell to protect your equity position. If you can't remain in your home due to physical or mental disabilities for a period greater than 1 year, FHA will consider the loan due, meaning that the home will need to be sold. In that case, you would still retain whatever equity remains. Now, what happens when you pass away? How does a HECM affect your heirs? To begin with, We'll evaluate the mortgage balance versus the appraised value. If the appraised value is higher than the mortgage balance, your heirs can sell the home and receive the remaining equity after paying off the HECM balance. In an extreme situation where you end up living into your hundreds or the housing market suffers a shock, you may find yourself in a situation where your mortgage balance exceeds the value of the home. Your heirs would have two choices. They could buy the home for 95% of its appraised value, or your heirs could give the keys to the bank and walk away. This is what's known as non-recourse protection. The only recourse the bank has for a mortgage balance that exceeds the home value is to accept the home in exchange. This is the protection provided to you and your heirs from the FHA mortgage insurance you paid up front. Okay, if you've done the math and are excited about what the reverse mortgage can do for your finances, you'll need a mortgage broker. Here's how to tell the legitimate ones from the ones you never want to do business with. First, are they licensed with the Nationwide Mortgage Licensing System, or NMLS? This is a state-specific license. You can verify someone's NMLS ID on the NMLS website. For example, I'm NMLS licensed in California, Oregon, Washington, Utah, Idaho, Colorado, Montana, New Mexico, Texas, and Florida. If you live in one of those states, please book a free consultation with me using the link below, and I'll be happy to help you evaluate your situation. If you live in another state and need a referral to a credible loan officer, I may be able to help. Now that you know they're licensed, ask them, how long have they been originating reverse mortgages? In your conversation with them, do they seem to have a deep knowledge of the topic? What are some examples of reverse mortgages they've helped clients obtain? Are they presenting you with other options besides just a reverse mortgage? Does their focus seem to be on educating you about your options or on selling you a product? Do they seem to be in a hurry to get you to make up your mind? Are they allowing you to move at your own pace? Are they clear about closing costs from day one? And are they able to explain the reason behind each cost? Will they be available to answer your questions after closing, even much, much later? I make myself available to answer questions from my clients months and years after they've closed on their reverse mortgages. Sometimes people call me to ask me if a piece of junk mail about their loan is junk, spam, or a legitimate piece of communication from their lender. Or they ask follow-up questions about something they may have known years ago when they first got their reverse mortgage, but can't remember now. Or they simply want me to reassure them that they've done the right thing in getting a reverse mortgage. The right mortgage broker creates a relationship, not just a transaction. Before we wrap up, this is a quick reminder to download your own version of the reverse mortgage calculator using the link below if you haven't already. Rewatch the video to go through the calculations and see if it's right for you. If you want some help with your reverse mortgage planning, feel free to book a consultation with me if you live in any of the states where I'm licensed. Again, that's the most Western states, as well as Florida and Texas. Oh, and that advanced retirement planning strategy I promised you in the beginning of this video, this is for those of you who want to optimize your investment strategy or for those working with a financial advisor. Here it is in a nutshell. By taking out a reverse mortgage as early as possible before you start using it, there's time for the reverse mortgage line of credit to grow at the rate of interest on your mortgage, as we saw illustrated in my calculator demo. This makes the line of credit available as a buffer asset, allowing it to help mitigate sequence of return risk. Sequence of return risk refers to the risk that comes from potential volatility in the stock market, particularly early in retirement. For example, if you're relying on withdrawals from your stock portfolio during retirement, a market downturn would make you hesitant to continue those withdrawals. Having a reverse mortgage line of credit available as an alternative source of funds during that downturn can be a lifeline, saving you tens or hundreds of thousands of dollars. I walk through a comparison of this coordinated strategy with other retirement investment strategies in another YouTube video. I'll link to it below. Thanks for taking the time to watch and understand how a reverse mortgage can be useful in your financial planning. If you'd like to talk with me, you can book a free consultation with me using the link below.